First, I gave an overview of what was happening in the U.S. economy, which in brief is that the U.S. consumer has very fast growing wages, extremely low unemployment, and as a result, spending by households has been very strong. There's been some deceleration, but still nowhere near what would be consistent with recessionary conditions. At the same time, this has engendered very high inflation, which has started to come down, but is still a long ways off from where the Federal Reserve would like it to be. As a result, we see a lot of economic indicators starting to show warning signs. So one of my favorite charts I showed was a composite index of 10 leading indicators for economic activity. All of them are down sharply year over year. We've never before had this happen before without a recession happening. Not once, going back all the way to the 60s. So if you look at any surveys of economists, they'll tell you that there's a more than even chance of a recession in the next 12 months. And this is certainly pricing into the bond and interest rate markets, which are right now discounting that the Fed will be forced to cut rates fairly significantly over the next year. For my part, I think that we're still a ways off from when an actual recession would start, given the strength of the consumer and given where the employment market's at. It just simply takes time for there to be that kind of deceleration. But I would still say that the most likely outcome is a mild recession inside the next 12 months. Now, where I disagree with the market, however, is that I see inflation slowing more slowly, and the Federal Reserve being willing to take more economic pain in order to ensure that inflation not only returns to target, but stays at target. And so that means that higher interest rates, tighter financial conditions are going to be here for longer than I think that the market is currently expecting. And that blended right into my talk about the U.S. capital markets on the real estate side. This has real world implications for the value of assets and for the activity in the sector. And it's all driven by debt. Debt is the only thing that matters right now. And the problem that we have there is that the largest source of capital for real estate finance are from banks. The next comes at CMBS and other kinds of securitized, then insurance, and then like professional debt funds. The problem is that banks not only layered in massively into real estate last year, but that now they're having these balance sheet issues, particularly at the small and regional banks. And while that stress has slowed down a bit, it's still going to impede them from being able to increase loan exposures like they had been. So this is happening at a time where we have over $1 trillion worth of real estate debt coming due in the next 24 months. So you're looking at a little less than $400 billion, we estimate, of bank debt that's coming due, another $300 billion of CMBS debt coming due, at a time when banks are pulling back from the sector. Now, so my question is, who's gonna come in and fill that gap? Okay, so it's not banks. What about the CMBS market? Well, here's the problem. The CMBS market has actually had the lowest issuance of new CMBS than it has in 11 years in the first quarter. And while that could reaccelerate, it's difficult to imagine that the market is not only going to be able to reaccelerate so much as to be able to deal with the refinancing of the existing loans, but then to provide incremental capital for these bank loans that the banks are trying to get out of. Look at life insurance, meanwhile. Life insurance, the problem for them is that, well, not the problem for them, the problem for us, is that they don't have to invest in real estate. They have other options. They don't have to go into the private market and lend on an office building. They could go buy a REIT bond, they could go buy a CMBS, or they could go loan to a corporate. Or heck, they could just put it in treasuries when the treasury rate's at 5%. So there's going to be limits on their ability to backfill this hole in the debt market. Finally, we get to the debt funds. Well, the debt funds have way more capital than they've ever had before, but it's simply not enough, and especially because the debt funds are so reliant on bank warehousing lines and selling their loans into the securitized market. So one way or another, we're going to end up with a giant hole in the middle of the debt complex at a time where you have $1 trillion coming due. So all that simply means is that you're going to have some distress, you're going to have loan modifications, you're going to see interest rates, even if treasuries come down, have to increase some in order to induce more capital into the sector. And this is going to cause really significant problems. First and foremost for office, given the decline in the value of office, which means that a lot of loans that were taken out in the last 7 years are now, they may have started out at 65% LTV. Now they're at 80, 90, over 100% LTV. On the multifamily and industrial side, you've seen prices grow tremendously. So let's say a loan was 65, now maybe it's 30. That's good. Here's the problem though. I was looking at, if you had a low debt service coverage ratio, and it looks like about 40% of multifamily debt in the securitized world had a debt service coverage ratio of 1.25x. So a little bit more, creating enough cash flow to cover the debt, but only a little bit more. Well, what happens when the interest rate went from 3 to 5, 3 to 6? All of a sudden, even these assets that have appreciated potentially now need equity injections, or at minimum, like their returns reduce. So the upshot of it is that we're going to see significant distress in real estate, mostly in office, but to a far greater degree than we become accustomed to, including in even the other strong sectors. So a couple things. So one is, if I'm right, and the Fed is going to keep rates over 4% for the next couple years, then that's going to limit Latin American central banks from cutting rates as much as they might have otherwise, because they need to keep a high enough interest rate to keep their currencies competitive with the US dollar. If they bring interest rates down too much, then all of a sudden the price of imports is going to go up because a lot of them are denominated in dollars. And then that would create more inflation problems and lead to higher interest rates anyways. So it means that on average, financial conditions will remain a bit tighter throughout Latin America, and not just Latin America. I'm not picking on Latin America. The second is that if the U.S. economy is slowing, that's going to contribute to less import volumes from the U.S. into Latin America. Now, the positive thing is that this is happening at a time where China's economy seems to be reaccelerating, and given that China is a major trading partner for many of the nations throughout Latin America, particularly Brazil, where I actually think that the relationship is larger than it is with the U.S., that'll be at least an additional source of demand, particularly for raw inputs. The other thing I think that's positive is that this will have less of an impact on foreign direct investment. The overall trends that we're seeing in the regional economy is towards more nearshoring, more friendshoring. So I'm very optimistic, in both the long and the medium term around economic ties between the United States and the rest of America, or the Americas, growing tighter and tighter. And now that's first in Mexico, but I think it's going to continue to extend down into the rest of the region.